Welcome back. In this segment, we'll be doing a small exercise, exercise 3. So in this exercise, we will be covering the items we discussed in the balance sheet so far, that is capital and reserves and surplus. For these two items only, we'll be exclusively devoting this exercise because it's a very important aspect. No, capital and reserves and surplus are the owner's funds. So you should be very clear as to what the owner's funds are, right? So in this exercise, we'll be reviewing the aspects of capital and reserves and surplus. So the first question is, if the liabilities, right, if the liabilities in a balance sheet show sources of funds, right, and assets show uses of funds, why does the balance sheet has to tally? So we always said that the balance sheet will be tallying. So if liabilities is 100, assets will also be 100. If this is 500, this will be 500. Always, right, always the balance sheet will be tallying. So this we already discussed in chapter 3, right, where we discussed the accounting process. There we said balance sheet will always tally because due to the dual aspect concept of accounting. See, the double entry bookkeeping. So that is fine. That is the technical part. But from a common sense point of view, if the balance sheet, we discussed that liabilities represent sources of funds. So all the items on the liabilities represent sources of funds, and the asset side represents uses of funds. So if this is the case, why should a balance sheet tally? So is it because if it doesn't tally, it will reflect poorly on the accounting team, right? Or because every rupee borrowed has to be accounted for? Alright, this is an easy question. The options are also simple. I just gave the answers to be very simple to make sure that you get the answer right. So the point is, every rupee borrowed has to be accounted for. So when you're saying the liability side represents sources and the assets represent uses, so the balance sheet will tally because we are accounting for every rupee that we are borrowed, right? For example, if we had raised 100 rupees from the sources, from various sources, from the owners, from the banks and creditors, various sources, we have raised hundreds. We have raised an amount of 100. Now on the asset side, we are showing the uses. We are telling how did we use this 100 rupees. So we have to account for each and every rupee how we spent. See, we can't say we can't account for 90 rupees and say I'm going to be silent on the 10 rupees. No, right? If you have borrowed 100 rupees, you have to tell what you did with that 100 rupees. Right? You can say we have purchased some land, building, machinery. But if it is adding up only to some 80, say this is 20, this is 30, this is 30. So this is only coming up to 80. You can't be silent about the remaining 20. You can't say I will only, in my balance sheet, I will raise 100 lakhs, but I will show only 80. The rest 20 don't ask me. That is a secret. No, you can't tell that. Balance sheet should tally because every rupee which you have raised on the liability side, say for example 100 lakhs, you have to tell what you did with that 100 lakhs. That is what the asset side tell. Asset side is the uses, this is the sources. So all the sources, how much you borrowed, if it is 100 lakhs, you have to tell what you did with each and every rupee of that 100 lakhs. You have to account for each and every rupee. This has to be 100, right? That is why balance sheet should always tally from a common sense point of view. See, from a technical point of view, it's going to tally because of the double entry bookkeeping. That is different. But from a common sense point of view, balance sheet has to tally because every rupee borrowed that is on the liability side, we are accounting for. It has to be accounted for on the asset side. What you did with the 100 rupees you borrowed, you have to show it in the asset side. That's why balance sheet will always tally, right? So the second question is, which of the following appears under liability in a balance sheet? Loan taken by the company from a director, loan given to a director by the company. So we already discussed liability and assets. So what we said, liabilities are sources of funds. These are the borrowings from various people. The company has borrowed funds. Assets are uses. What did the company do with these funds? So here in the first example, the company has taken a loan from a director. So there is a director and the director has given some money, say 10 lakhs, has lent the money to the company. So if we're speaking from the company point of view, the company is borrowing, right? The company is borrowing an amount of 10 lakhs from a director. So it is a source of fund, right? So this will appear under the liability side. What is the second one? Loan given to the director by the company, right? The company has now given a loan to the director. So you can say this is a use. The company has got some funds from various sources, and what it did, some part of it has lent to a director. So that is a use. In the second case, it is a usage of fund from the company point of view. This is a source of fund. So the first item will be a liability. The second item will be classified under a asset, right? Next question. The capital contributed by the promoters is 60 crores, right? At the time of winding up of company, the company has recovered 750 crores by selling all its assets. If the total of liabilities is 800 crores, which of the following is true? Scenario is, the company has winded up, right? The business is terminated and it has sold all its assets. So how much did it recover? 750 crores. Now it has to settle the dues of various parties. The total of the liability side is actually only 800, right? The total of the liabilities was only 800. So somebody is not going to get paid, right? So let us assume there are some owners here, there are some banks, right? There are some creditors. So various parties, various lenders are there. They want their dues to be settled, right? But somebody is going to has to forego the 50 crores, right? Because only 750 crores are available, whereas all the dues put together is 800 crores. The question asks, which of the following is true? The raw material suppliers will absorb the shortfall of 50 crores. So for example, the creditors here is some 200 crores. The question is saying, so will you give the creditors only 150 crores instead of 200? Because we have a 50 crore shortage. While the sources, while the amount which you receive by selling all the assets is only 750 crores, all the lenders put together is 800 crores. So there is shortfall of 50 crores. So who has to absorb this 550 crores loss? The first option is, for example, if the creditors, the raw material suppliers, you are due to pay 200 crores to them, they will absorb the loss of 50 crores. They'll absorb the 50 crores. So they will be paid only 150. Is this correct? Or bankers will absorb the shortfall of 50 crores. So for example, the banks have some outstanding of 400 crores. You're going to pay only 350 crores. So will they take only 350 crores? By sanctioning a new loan repayable within 5 years, maybe that 50 crores they will sanction as a fresh loan. Will they do that? Or promoters will settle dues of all others and take only 10 crores for themselves. So what we are saying is, so what is happening in this example here? So you have a company who has some liabilities and assets. So the company is now wound up and it has realized an amount of 150 crores by selling all its assets, right? But the liabilities, that is the dues to be settled, are 800 crores. Here we are given some breakup. We are saying the owners have contributed some 60 crores. This is their capital. And there are some other lenders like banks and creditors and various others. Put together, these are the balance 740 crores. So 60 crores is the capital of the owners and 740 crores is the outside borrowing. So to put together, this is the 800 crores. So now the company has realized only 750 crores by selling all its assets, whereas the dues are 800 crores. There is a shortfall of 50 crores. So who is going to absorb this shortfall? So we already discussed neither bankers nor the creditors will be accepting the shortfall. They won't say, give me 50 crores less. They're not going to say you have to pay this 740 crores first to them, because you have available 750 crores. So since 750 crores is available, pay 740 crores to them. How much is left? 10 crores is left. This 10 crores will be going to the owners, even though they pumped in 60 crores as capital. So the 50 crores loss is going to be absorbed by the owners. This we already discussed, right? All profits and all losses have to be borne by all profits will go to the owners and all losses have to be borne by the promoters. So here first the 740 crores, the outside borrowings will be settled. So out of 740 will go to the bankers, creditors and other outside parties. The balance 10 crores will be going to the owners, even though they originally contributed 60 crores. So even though they pumped 60 crores, they'll be getting only 10 crores back. So that 50 crores loss is going to be absorbed by them. So the answer to this question is, the third answer. The promoters will settle the dues of all others and take only 10 crores for themselves, right? Let us see the fourth question. So by changing the accounting policy, a company cannot change which are the following asset items. So inventory, depreciation, net block, or fixed deposit. So we already discussed that a company will be having some flexibility regarding the accounting policy to be followed. This we already discussed, and we mentioned that the important significant the policies will be mentioned as the significant accounting policies in the auditor, right, in the balance sheet. So here, by changing accounting policy, which of the following item you can change the amount? Inventory, yes, definitely you can change inventory by following a different accounting method. For example, by following a different valuation. Inventory, we didn't come to inventory, right? We'll be discussing this under the assets when we discuss about assets. So there you'll be seeing assets can be valued by different methods like FIFO or LIFO or weighted average, various other methods. So if you follow one method, you'll get one closing value, the inventory value, right? The inventory value will be one value, other method, other value. So you can change the value of the inventory appearing in the asset side of the balance sheet, right, by changing the accounting method, the valuation method. So this you can change. What about depreciation? Definitely you can change. This we already discussed under while discussing P&L account depreciation. So depreciation can be calculated by various methods. Two of them are straight line method and WDV method. There are other methods like sum of digits method and various other methods. So if you calculate depreciation by one method, you'll get one value. If you calculate depreciation by another method, you'll get another value. So you can change depreciation value by following a different a method of calculation of depreciation. Net block, obviously. Net block is nothing but gross block minus depreciation. Gross block will always remain same, right? That's not going to change. But depreciation, just now we discussed, is going to change based on the accounting method, the method of calculation. So obviously net block you can affect net block by following a different method of depreciation. So this also this can change, right? So which is the item that cannot change is fixed deposit. See, a bank fixed deposit has got nothing to do with the accounting policy. For example, if you have a deposit of 10 lakhs in a bank, it's going to be 10 lakhs irrespective of what accounting, if the company has 10 lakhs deposit in the bank, right? If the company has deposited 10 lakhs in the bank, irrespective of what, it has got nothing to do with the accounting method. Any balance sheet, you are always going to show 10 lakhs. This fixed deposit under the assets is always going to be 10 lakhs. This has got nothing to do with the accounting policy. So the answer to this question is the fourth option, that is the fixed deposit, right? Next, share premium appears under which item in the balance sheet? Share premium, whether it appears under capital or reserves and surplus, or 50% on the capital and 50% under reserves and surplus. So we already discussed a company can issue shares for premium. We are not going to discuss this again. Please refer back to the segment where we discussed about share premium. So briefly, for example, a face value, a share with face value of 10 rupees can be issued for say 100 rupees. That this the company can do based on its reputation. If people are really willing to purchase shares of this company, a company can issue a share of 10 rupees face value for 100 rupees. So the 90 rupees is known as premium, right? It is known as the share premium. So when the company, this is what is all this? This is a public issue. The company is raising some amount from the public by issuing shares. So this will be all the money which is going to get is the share capital. These are the owners of the company. So this is a share capital. So this will go to the share capital, fine. But how much? So here there are two parts. One, 10 crore is the face value, whereas the remaining 90 crores is the premium. 10 is the face value. This is going to go into the capital, whereas this will go to the reserves, right? So if you see here, liabilities, you have the first two items in any balance sheet will be capital and reserves and surplus. So in this capital, you always show the face value of the shareholding. You got nothing to do with the market value or the premium. You got nothing to do, only the face value of the share. So here the face value is 10 crores. So this will go under capital is 10 crores here. In reserves and surplus, you have various items. One of the item is a share premium. There you will show this 90 crores, right? So the answer to this question is reserves and surplus. This we already discussed in our earlier discussion, right? Next question. The land appearing under assets is revalued from 50 lakhs to 75 lakhs. So what will the cash of 25 lakhs do? So liabilities assets, here you have various assets. One of the assets is fixed assets. So under fixed assets, we have assets like land, building, machinery, various. So land in 1 year's balance sheet, say for example 31/3/2013 balance sheet, the land is like 50 lakhs. Then we are in the next year balance sheet, 31/3/2014, the company has revalued the land, right? So here the land is now appearing to be 75 lakhs. This is revaluation, right? So the question asks, this 25 lakhs difference, this 25 lakhs excess cash which the company has received, what will this cash do? Will it increase the bank balance, or will it decrease the bank loan outstanding, or will it help us in repaying the raw material suppliers, or there is actually no cash, this is only a book entry? So which of these answers is correct? Right, if we have followed the discussion under reserves and surplus, we discussed, right? Under the segment of reserves and surplus, we discussed an item called revaluation reserve. There we said revaluation reserve is only a book entry. You will not get any cash here, right? This is not like share premium. In the earlier example, we spoke of share premium. Share premium in this fifth point, we discussed about share premium. Share premium is something you get cash, right? If you issue a share or 10 rupee share for 100 rupees, you're going to get 100 rupees cash. This includes 90 rupees of premium. This is cash. You're getting funds here. But this is different. You're just in the books only, you're valuing 50 lakhs to 75 lakhs. When you'll get 75 lakhs, only when you sell this land, you're going to get 70 lakhs. Only at the time of winding up the company, when you sell the assets, you'll get that 75 lakhs. Till that time, there's no cash here. This is only a book entry. So there is no cash. So this question is actually googly, right? So now this is correct. This is only correct. There is no cash. Revaluation reserve is always a book entry. And that's the reason why we discussed. That is exactly the reason why bankers will ignore it. Bankers should ignore it. As a credit officer, when you get the revaluation reserve, what you should do? You should ignore it. How you'll ignore it? We discussed how you're going to cancel that revaluation aspect. How On the liability side, you deduct it from the reserves and surplus. So reserves and surplus will go down. For example, if 25 lakhs, this 25 lakhs in this example, this 25 lakhs on the reserves and surplus, how the entry is going to look like. So the revaluation, now the land is 75 lakhs. So how, and you have created a correspondingly a revaluation reserve of 25 lakhs. So how you are going to cancel this? We said that bankers should ignore this. So as a credit officer, you should ignore this. How you are going to cancel that revaluation aspect? How to cancel? One, reduce the reserves and surplus by 25 lakhs. So if this reserves and surplus is, say for example 200 lakhs, after considering this revaluation reserve, for example, the various other items in reserves and surplus like surplus in profit and loss, share premium, various other general reserve, capital reserve, all put together is 175 lakhs. So this revaluation reserve is 25 lakhs. So put together reserves and surplus is 200 lakhs. And this fixed assets net block, finally you have some 475 lakhs. So what you should do to cancel this revaluation aspect? Decrease the 25 lakhs revaluation reserve. So reserves and surplus, now you are going to take only 175 lakhs. So that 25 lakhs is gone. Decrease. So the balance sheet is not tallying because liability side you have reduced 25. What are you going to do? Similarly, that 25 lakhs you again deduct from the net block. So this is 475 lakhs, right? So now you show this only 450 lakhs, right? So this also, the asset side also goes down by 25 lakhs, and again balance sheet will tally. We discussed already this in the segment in reserves and surplus. Please refer back. So this is how we cancel the revaluation aspect, right? So let us see the seventh question. A company was sanctioned term loan of 400 lakhs to meet project cost of 500 lakhs on 15/4/2013. So in April 2013, the company was sanctioned a term loan of 400 lakhs to meet the project cost of 500 lakhs. So obviously, the promoter's margin is the balance 100 lakhs. So 400 lakhs is the bank term loan, and 100 lakhs is contributed by the promoters. This is the equity, fresh equity by the promoters. And the project was completed in 24/1/2014. The date is not relevant to us. Exactly what we are saying is the project was completed before 31/3/2014. That's what we are saying. So this loan was sanctioned after the balance sheet of 31/3/2013. So there are two balance sheets here, 31/3/2013 and 31/3/2014. So as on this date, the project has not started because the loan was sanctioned. Loan itself was sanctioned in April. So this has come after that. The loan sanction has come after this balance sheet date, but the project was completed before this balance sheet date. So everything, whatever entries we are going to consider, the fixed assets, term loan, everything is going to be happening in this balance sheet date. So let us see. So here we are given the balance sheet for the 2 years, right? So this is 31/3/2013 balance sheet. Here the loan was not yet sanctioned. So this is the position. This is the position before the loan was sanctioned. And then 31/3/2014, this is the position. And change is given. So here the question is, can you spot the negative points in this proposal? So what are the negative points? So this again we discussed in our discussion under capital, right? In capital we discussed one very important point, that you have to always ensure that the envisaged capital, right, the borrower's margin is always brought in. You have to ensure this, whether the promoters have brought in the envisaged capital. Let us see here. The project cost was 500 lakhs. So out of this, bank has sanctioned 400 lakhs. So the remaining 100 lakhs the promoters have to bring in 100 lakhs. If you see here, 31/3/2013 anyway, the project has not commenced. 31/3/2014 the project is completed. So here if you see, the entire project should be reflected here. If you see here, the bank loan 400 lakhs is reflected here. You see here, term loan 775 plus 400 is 1175. Actually you in practice you won't see this because there will always be some repayment in the 775. So it will be reduced, say for example some 700 or 600. But the point is, you know what is the repayment structure of this company, so you can adjust that. So for example, if the repayment is some, say 50 lakhs during this 1 year, so 775 minus 50, so you actually have some 725, right? So to that you will add the 400 and then say 1125. So if the loan is fully availed, it should be 1125, provided the repayment for this has not yet started. If the repayment has started for this, say 10 lakhs, then it should be 1115. Anyway, the working is not that important to us. In this example, we are given a very simple scenario where this repayment there is no repayment here. So directly the 400 term loan is added. So plus 400. The change here is plus 400. Okay, the company has fully availed the loan. Out of the 500, 400 is going to be from bank loan, 100 is the margin. So the company has fully availed the 400 lakhs of loan, which is reflected here, right? So term loan has increased between the 2 years but by 400 lakhs. That is correct. So if you see the fixed assets, this is the project cost. So here again, the project some 300 lakhs towards building and 200 lakhs towards machinery. So this is a plus 500. So the project was completed. So between these 2 years, the fixed asset, the gross block has gone up by some 500. This is actually, this should be net block. In the assets you take net block, but anyway, let us ignore depreciation for the moment. So the 500 lakhs is also reflected. So this is reflected, this is reflected. What about this 100 lakhs? Is the borrows margin brought in? So if you see here, the capital was 100 lakhs last year. Now it should be 200 lakhs, right? Or if not, at least if the company had earned some profits, the profits have to be pumped in, because these profits is also retained earnings, is also part of the promoters funds, right? Even though we actually insist on fresh capital for a term loan margin, but anyway, if the company had earned profits, okay, the company could have used some part of the profits towards capital. But if you see, actually the reserves have come down. So 250, 240. So this company has actually made a loss in this financial year 2013-14. So there's no question of the profits being used for capital. So there's no profits here. There's a loss here. So the capital had to be definitely plus 100 plus 100, 200, it should be there. But if you see, capital is only 160. There's a shortfall of 40. So the promoters didn't bring their entire margin. The envisaged capital of 100 lakhs was not brought in. You see, so if the company had made 50 lakhs profit, the reserves would have increased from 250 to 250 plus 50, 300. So there are some retained funds in the system. So even though the company could not bring, the promoters could not bring in the entire margin of 100 lakhs in the form of capital, 60 lakhs was brought in as fresh capital. We can say the balance 40 lakhs was contributed from some, say, retained earnings or something, you can say like that, or some unsecured loans. Here there's no unsecured loans, but here the situation is different. The company has actually incurred loss during this year. So the margin should have been brought only from the capital sources, which the company did not do. While the envisaged capital was 100, the company has brought only 60. So there is a shortfall in the margin of 40 lakhs. But then how was the project completed? You see here, the project cost was 500 lakhs. 400 lakhs bank has given. The promoters have actually brought in only 60. You see here, the project was the new building, additional machinery, totaling 500 lakhs was built. Of this, bank has financed 400 lakhs. Fine. But the promoters brought in only 60. So who financed that balance 40? Right? So 400 plus 60 is 460. But still there is a shortfall of 40. We are saying the promoters didn't bring in the margin. Bank sanctioned only 400. So where did the 40 come from? Because the project is completed. Because 500 was spent. 500 was spent without the total of bank and promoters. Bank and promoters have put in only 460. So who brought in the balance 40 to ensure that the project was completed? From where did this 40 come in? Right, you cannot answer this question right now. This we will discuss when we go to working capital, when we discuss about diversion of funds and things like that. For the moment, please understand that if you see here the OCC, see the only current item, these are all long-term sources, right? Up to here all long-term sources, and here all are long-term sources. So the only current assets are current items are here. Current asset, OCC is a current liability, and inventory is a current asset. This is only two items related to the current portion. If you see here, the OCC has gone up from 200 to 305. So the bank has also not just sanctioned 400 lakhs term loan, it has also enhanced the OCC limit from 200 to 305. So OCC has gone up from 105. But if you see the inventory, that's the only current asset item, it has gone up by only 75. So there is a 50 lakhs which was meant for working capital purpose, like inventory or debtors or some working capital purpose. It was not spent for that purpose. That 50 lakhs was diverted towards this project, towards this expansion project, and therefore that 500 lakhs, right? Therefore the 500 lakhs was met by term loan of 400, right? Promoters 60, and the balance 40 was met from the working capital funds of the bank. So the bank actually sanctioned 125 enhancement, but actually the company utilized only 75 lakhs towards the working capital. The balance 50 lakhs was diverted for some uses which were not meant for working capital. Out of this 50, 40 has gone towards the project, and 10 lakhs, if you see the loss is 10 lakhs. So all these things we will discuss in detail in future chapters. This is not the time to discuss. But the question is, can you spot the negative points in the proposal? So what are the negative points in this proposal? One, the company has made a loss. You see here, reserves have decreased from 250 to 240. When you see reserves decreasing, means the company has made a loss, because the resultant figure, we discussed that in the P&L account, the last and final figure is the retained earnings after profit and loss appropriations. We discussed briefly about appropriations. The profit after tax will be appropriated into various heads, right? So there is the surplus in profit and loss account. If there is profit, the surplus in profit and loss account will be increasing. That is, the reserves will be increasing. So if you see the total of reserves, all reserves put together has actually decreased, you can say that the company must definitely have made some loss. So here the one negative point is the company has made a loss. The other negative point is the margin, the envisaged margin. The promoters didn't bring in the entire margin of 100 lakhs. See, they brought in only 60 lakhs. There is a 40 lakhs shortfall. And the third negative point is there was a diversion of funds. This again is something which you may not be very comfortable at this stage, but there was some diversion of the funds in the sense that out of the 500 lakhs, 400 lakhs was financed by bank. The promoters brought in 60 lakhs, and the balance 40 lakhs was drawn in from working capital. The bank OCC funds were diverted to this project. The bank has sanctioned the enhancement of 125 lakhs for working capital purpose like inventory and debtors. But actually that only 75 lakhs has gone towards the working capital purpose. There was some diversion of funds. So that is the third negative point, right? So let us see the eighth question. Retained earnings can be used as form of promoter's margin, right? So out of term loan margin and working capital margin, which margin do you prefer as a banker, right? Which margin do you prefer retained earnings to meet? So this we already discussed. This is very simple. We said that the company will be having some profits every year. If it's a profit making company, the company will be making profits. So if a proposal comes to you, a new term loan proposal, so say for example 100 lakhs is the project cost. So out of this, bank is sanctioning 75 lakhs and 25 lakhs the promoters are going to pump in. So the promoters will say, we will not bring in fresh capital. Since we are earning some profits every year, some of this margin will bring meet from retained earnings. So can you accept it? We already discussed that there is nothing wrong in it. Many companies do this and banks sometimes accept it. But the point is, as far as possible, please always ensure that the terminal margin is met from fresh capital, fresh or additional capital. The terminal margin is met, and the retained profits can be used to improve the working capital to meet the working capital margin, because as the company grows in size, definitely will be requiring more and more working capital. The working capital requirement will go up. So definitely they have to increase their margin in working capital also. So that can be met from the retained earnings. So which of the margin do you prefer to from the retained earnings to meet? It will be working capital margin, right? Terminal margin always better to meet from the additional capital, right? So next question, the question 9 is in 7 above. That is the table which we discussed, right? This is the table, right? So in 7 above, calculate percentage increase in net worth, right? Percentage increase in net worth between 13 and 14. So you have to calculate what is the increase in net worth. So net worth, again we are very clear, right? We discussed what is net worth. Very simple formula. Net worth is just the sum of capital and reserves and surplus. Of course, there's a small condition here, assuming that there are no intangible assets. In this case, there are no intangible assets, right? So capital plus reserves and surplus. So 31/3/2013, what is the net worth? It is capital 100 plus 250, right? Here it is 160 plus 240, right? So here it will be total of 400, and here it is 350, right? So the percentage increase, that is 50 by 350, around 15% you will get, right? So the increase in net worth. So this example is basically to familiarize you with the calculation of net worth. Don't worry about the percentage increase in net worth. Basically, to calculate net worth, it's a very simple formula. Net worth is capital plus reserves. When you're given a balance sheet and you're asked to calculate net worth of this company as on this date, just add up the capital and reserves. You'll get the net worth. So next question, 10th question. If the company in 7 is expected to make loss of 100 lakhs every year starting from financial year 14-15 till 19-20, in which year the entire net worth will be eroded? Can you answer this? So the question is saying, from the next year, that is starting from financial year 14-15. This is financial year 13-14. So starting from this year, we are expecting the company to make a loss of 100 lakhs till the year 19-20. These are expectation. So in which year you think the net worth will be completely eroded? So or in other words, when will the net worth become zero? If you see, net worth as on this date was 160 plus 240, that is 31/3/2014, the net worth is 400. Now next year we are expecting a loss of 100. So what happens? The reserves will come down by 100. So reserves will now be 140. Capital will be 160 anyway. So next year reserves and surplus put together, that is net worth will be 300. That is as on 31/3/2015. In 31/3/2016, the next year, another 100 lakhs you're expecting loss to be made. So capital will be 160 still, but reserves will be coming down to 40 because the loss will be reducing the reserves. Then you have net worth of 200. Then 31/3/2017, capital will be, you see here, the reserves is only 40, whereas the loss is 100. So put together, capital will now start to be eroded. The capital will be beginning to be eroded. So actually you won't show, if this is a company, you don't actually show capital to be reducing, you actually show it on the accumulated loss. So what you show, capital will be 160. So let us have this more clearly. So capital, reserves and surplus, right, and net worth. Net worth is nothing but capital plus reserves, right? So here 31/3/2014, then 15, 16. This is going on up to 18 because till 2020 are expecting this every year 100 lakhs loss to be incurred. So let us fill these figures. So this figure is available with us. 31/3/2014, the capital is 160 lakhs, reserves is 240, and total net worth is 400. So now we are saying the company is going to make a loss of 100 lakhs every year. So next year this reserves will be coming down by 100. So this will be 140. And what is the net worth? 160 plus 140, 300. Next year capital will still be 160, reserves will be 40, this will be 200. So the next year when the company makes a loss of 100, you might say since only 40 reserves are available, reserves will become 0, balance 60. This is how it's going to be. It's not correct. Well, actually net worth is still going to be 100. You're absolutely correct. Net worth is going to be 100, but that is not how we show, because for a company capital is not something that can decrease, right? So even though here really capital is eroded, that's right, but the way we show it is we will show capital still as 160, right? We will show capital as 160, and then here we will create on the asset side. This might be confusing to you. We'll discuss this when you come to the discussion of assets. But on the asset side, you have something called intangible assets. There you have an item called accumulated loss. So there you are going to show accumulated loss of 60. Is this clear? We will not decrease the capital. We will still show capital 160. Reserves anyway, reserves completely 0. The balance 60 will show here. So now what is net worth? Net worth we said is capital plus reserves. But if there is intangible assets also, then net worth is capital, because and then we modify it as tangible net worth, right? So it will be capital plus reserves and surplus minus intangible assets, right? So in this case the net worth will be 160 plus 0 minus 60, it will be 100. Is this clear? So next year when the company makes again a loss of 100 lakhs, capital will still be 160, reserves anyway there is nothing to decrease, minus, so that will be 0. But now you will be showing a accumulated loss. This is earlier it was 60, now it will be 160. You see here, earlier when we had some reserves, we are going to decrease the reserves. But once reserves become 0, what we are going to do? We are not going to decrease capital. We leave capital untouched, and then we will create a new item called intangible asset. Under intangible asset you have accumulated loss. So last year accumulated loss was 60. Now additionally again the company has made a loss of 100. So now the accumulated loss will become 160. Now the accumulated loss is 160. So what is net worth here? Net worth is capital plus reserves minus intangible assets. 160 plus 0 minus 160. So net worth has now been totally eroded. As on 31/3/2018, the net worth has been completely eroded. Is this point clear? So we'll discuss this intangible assets later under the items of assets. But please note that usually it is a convention that you're not going to touch capital. Capital is not going to decrease. Here actually capital is completely eroded. You're right, capital is eroded, but we're not going to show it. We are going to show capital 160 as it is. Reserves you go on, keep on decreasing till it becomes 0. So once it becomes 0, the balance portion, see here in this year there is a loss of 100 lakhs, but you have reserves only 40 to decrease. So the balance 60 you're going to, instead of decreasing on the liability side, you're going to increase on the asset side. The net effect is same. Instead of decreasing the 60 on the reserves on the liability side by showing minus 60, instead of showing minus 60 you're showing plus 60 on the asset side. Both are same. Either you show liability side minus 60, or on the asset side you're showing plus 60. The net effect is 0, right? So what we are showing here, instead of decreasing that minus 60, you're going to show a new item called intangible asset accumulated loss 60, and therefore the net worth in this year is 160 plus 0 minus 60, 100. In the next year that loss of 100 is going to wipe out completely the net worth. Capital will still be 160, reserves will still be 0, but accumulated loss now will be 60 plus 100, 160. So the net worth will be 160 plus 0 minus 160, 0. In the next year again if it is a loss, If again the company makes loss, what will happen? Capital still 160, reserve 0, accumulated loss now will be 260. Right? The net worth is now become negative. In the final year, 160, 0, 360 minus 200. Is this clear? So the answer to this question is, when is the net worth going to completely eroded? Net worth is going to completely erode in this year, 2018. Right? So the answer to this question is 2018. This is 2018. So next question, what will be the accumulated loss beyond as on 31/3/2020? This we already calculated just now. So 31/3/2014, you had a net worth of, this is capital 60, 160, reserves and surplus 240. So net worth was 400, right? Then in next year 15, net worth has come down to 300, right? Because this reserves is 140, this is 160. Next year 16, this is 160, 40. You have 200. Next in 17, you had an intangible asset 160. So this will be 0, but accumulated loss will be minus 60, right? Accumulated loss will be 60. In effect, it will be minus 60 on the liability side. This will be 100. So 18, net worth is becoming 0. So accumulated loss is minus 160 here. 19, accumulated loss is 260, right? And 20 is going to be minus 360. The answer is minus 360. 360. Accumulated loss is going to be 360 as on 31/3/2018. Right? Please be clear on this calculation. So with this, we come to the end of this segment. This is a small exercise meant only to ensure that you have grasped the concepts of two important points, right? That is reserves and surplus and capital. These are the two items on the liability side. The first two items you see in any balance sheet under the liability side. Very important items, because they are the owner's funds. This is the owner's contribution. One, the direct capital infused, and this is the retained earnings. So these are very important items. So this exercise must have further confirmed your, must have further enhanced your understanding of the core concepts of capital and reserves and surplus, right? So in the next segment, we will continue our discussion of the liability items, and in the next segment, we'll be starting our discussion on term liabilities, right? See you then.